Okay, so hello everyone, welcome to RBI 247 sessions and a very good evening to all of you. Good evening everyone, good evening Anushka, good evening Yogendra, good evening Karan, good evening Afsana, good evening everyone. Welcome to RBI 247 sessions. Okay, so before we start our session, as we know that we are going to talk about this new free resources that we are going to make you available in our website, that is anujindal.in. You can simply log in, you can simply search this website and go to free resources and go to free practice questions. Now, why we are talking about it so much? Because these are going to be very helpful for your examination, whether it is RBI grade B, whether it is SEBI, NABARD. These practice questions are related to your syllabus. Right now, you can see that these questions are related to finance. Both basic and moderate level questions are being available to you. So more questions like such of different levels, like basic, moderate and difficult level, will be made available to you, and more subject will be added in this website, so that will be available to you, and you can practice these questions for your examination. And I hope that these are going to be very helpful. So do check these practice questions. Okay, so let's start with our session. Okay, I hope everything is fine with the audio, everything is fine with the PPT. You can simply watch my PPT and you can hear me properly. Please give me a thumbs up. Okay, my voice is low. Okay, I hope this is fine now. Okay, okay. So everything is fine with the audio and the video. Now we can start with our today's session of RBI 247, wherein we are going to discuss a very important uh, report, that is Financial Stability Report December 2024. Today we will be covering the first chapter of the report. This is going to be very important. Covering this is very important because why? These can any fact related to this report can be asked in your examination, phase 1 or phase 2. It can be a case study based question as well, and can be a filler, can be a match the following. And do remember these facts. I know the FSR report is quite factual and there is not much to understand in this, but we are going to make it simplify for you so that you can remember the points and the facts based on the understanding of these factual indicators and the metrics. All right. Okay, so let's start with what is FSR. What is FSR? That means what is Financial Stability Report. So as the name tells you that Financial Stability Report talks about the financial stability of our economy. Now, how do we define that? How do we assess that whether our economy is financially stable or not? So there are different kind of sectors that we use to assess in order to get whether our economy is financially stable or not. What do? We collect data related to banks, related to mutual funds, related to insurance sectors, related to pension schemes. All such data is being collected for the assessment of financial stability. Now, why we are taking mutual fund, insurance companies and non insurance companies or pension schemes or NBFC into this? Because all these institutions are interconnected, and hence a collapse of a single institution can lead to a global disruption or global financial disruption or the economy disruption financially, and hence there is a need to look at each and every aspect of the sectors, okay, that are interconnected with the financial services or financial sector as a whole. So here we are discussing what is financial stability report. Let's just read out through the PPT that says that FSR reports reflect the risk to the financial stability. So this report also highlights the risk that can be a potential risk that can impact the institutions, the financial institutions of the economy, and how we can mitigate it, right? The recommendations and the suggestions that this FSR lays down to you is also important for the exam point of view. You can simply highlight these points in your descriptive answers as well. So try to be attentive throughout this session. Okay. And the resilience of the Indian financial system. Now, what do we mean by resilience? Resilience means how a bank can bounce back from that crisis. That power to bounce back from that crisis to the normal level is the resilience. Now, the more resilient the financial institutions are, the more good it is for the economy. Okay. The second point says that prepared after taking into account the contribution from the all financial sector regulators like RBI, SEBI, PFRDA, EPF, all such institutions and their data, qualitative data are being assessed in this report that we have already discussed here, right? It is a report that is being released biannually. We know this, okay? Every 6 months, this report is released by the RBI, okay? Now, this report consists of 3 chapters. First is macro financial institutions, soundness and resilience, financial institutions, soundness and resilience, regulatory initiatives in the financial sector, and at the end we have systemic risk survey, which is going to be very important again, and it is a part of FSR that we will going to discuss in the coming section. Okay, so today we are going to cover this part, that is the macro financial institution. This is a very lengthy report and hence we are covering it in different sessions. Okay. So why we are discussing it? Financial Stability and Development Council. It is a council. It is a council which is a non-statutory council. Okay. Now what do I mean when I say that it is a non-statutory council? It means that it is not formed out of any law or act. It is not formed out of any law or act. Okay, so this is a council that has been created out of executive order. Okay, it is a recommendation by the government to create such council in order to check what are the risks and what are the performance of these institutions and how these institutions are interrelated in our complex structure of Indian economy. Okay, so it is written here that FSDC is a non-statutory apex council, okay, under the Ministry of Finance. Okay, it is created under the executive order in 2010. It is a very important and basic information related to financial stability report, and hence we are discussing it here. Okay, it was first proposed by the Raghuram Rajan committee in 2008, and who is the chairperson of this council? The finance minister is a chairperson of this council. And who all are the members of this council? All the regulatory bodies like SEBI, RBI, PFRDA, IRDAI, FMS, all these are important members of the council. And along with this, Finance Secretary, Department of the Economic Affairs, Department of Financial Services, and Chief Economic Advisors are also a part of this. Okay. And what are the functions of this council? The function of this council is to ensure that there is a financial stability in the economy. Okay. And provide them recommendations. Why I am using recommendation? Because whatever recommendation they are giving to these regulators or the governments are not mandatory in nature. Okay. These are the recommendations that can help the financial institutions, regulators to improve their performance or to mitigate the potential risk in the economy. Okay. And enhance, what is the another function of this council? To enhance the inter-regulatory coordination, ensure that each and every regulator is coordinating with each other, ensuring that each policy that is being made by a single regulator is aligning with the overall goal of the economy. Okay, so hence this is their duty to ensure that the inter-regulatory coordination is being there in the financial institutions. Okay, and ensuring that there is a development in the financial sector. All right. What is the third point says? Third point says to monitor the macro-prudential supervision of the economy. Now, apart from giving a suggestion, it is a duty of them to supervise the economy based on the key metrics that defines whether the financial sector is performing well, it is stable or not, it is resilient enough or not. These are the points that are being considered in these FSDC. Okay, now there is a committee. There is a committee, subcommittee of this, subcommittee of FSDC. Now, what this subcommittee of FSDC do? This works at the ground level. This work at a ground level to assess all the data and to create this FSR report. Okay. This subcommittee ensures, the subcommittee of this council ensures that it is working in the ground level to assess all the qualitative data in order to interpret whether the economy is financially stable or not. And who is the chairman of this subcommittee? It is RBI's governor. Okay, and who all are the members of this subcommittee? Same as FSDC, all the members that are available, that are the members of the FSDC, along with this deputy governors will going to be a part of this committee, and additional secretary will also going to be a part of this committee. Okay, now secretariat. Who is the secretariat? The Financial Stability Unit of RBI. Now this is a unit that also ensures the financial stability or also checks the financial stability of the economy. Now this unit of the RBI, this was established by the RBI in 2009, and this along with this committee, along with this FSDC subcommittee, ensures and works together in order to interpret the data, assess the data, and analyze all the factual points. Okay, now these two units, Financial Stability Unit and FSDC subcommittee, coordinate with each other, work together in order to create this FSR report that is being released by the RBI biannually. Okay, now what are the functions? The function is to look at the detailed technical issue and meet more frequently than the main council. So this committee meets more frequently than the main council, the apex body of the apex council of this subcommittee. Okay, this is the additional information. I hope everything is fine till now. Ma'am, voice is low. Can you please tell me if voice is still low? Or everything is fine with the session? So I hope everything is fine with the session. Okay. Okay. Let's look at the key highlights of the report. Now, key highlights of the report talks about three major things. That is, first they look at the global data. Okay, the global projections and the global level. What is the financial stability performance, right? Then they come to the domestic level, that is at the India's level. What is the financial stability, overall financial stability? Then they come to banking system, and then NBFCs, and then mutual fund, and slowly we will go dig deeper and deeper into the minor financial institutions and sector of the economy. And this is how we have structured our this session as well. First we will talk about the global level data, then we will move to domestic level data, and slowly we will move towards the minor institutions so as to conclude whether the economy is financially stable or not. Okay, so let's look at the first point, which says that the global economy and the financial system are stable. The report says that the global economy and the financial system is stable enough, but however there are some risks that are high public debt. That means there are high level of debt by the government, and hence it is a part of risk. It is a risk that can emerge as a one of a significant risk for a financially stable economy or global economy. Okay. The second point says the overvalued assets. Now, what do we mean by overvalued assets? Overvalued assets are the assets that are being artificially, their price is being artificially increased, and they are not showing their fundamental or their original value, and hence this is causing a risk, because at the time of financial crisis or at the time of some crisis, these overvalued assets will give a shock to the economy, because their prices will fall down rapidly, and this is not a good sign for the economy, and hence overvalued assets are not good for the economy. Ongoing geopolitical tension, we all know that geopolitical tension around the countries are creating a sense of insecurity among the individuals and the citizens, and hence it can create a sense of risk among the financial sectors as well. Okay. Challenges from the new technology. Now, technologies like AI and cryptocurrencies are, increasing the technological risk, because these are the technologies that are working at a significant level. People are relying on these AI tool and using cryptocurrency significantly, and this can lead to a problem. Now why cryptocurrency is a problem? Now, if people start putting majority of their money towards the cryptocurrency, now the policies that are being laid down by the monetary policy or by the central banks, they will not get impacted. Okay. Now, if they are increasing the rates or they are managing the liquidity in the Indian financial system, all such targeting, all such policies will be ineffective, as people have put their all money in the cryptocurrencies. Now, the effectiveness of that policies to that cryptocurrency is very minimal, and hence the cryptocurrency are not a good sign. People's over reliance on this cryptocurrency is not a good sign. Okay, I hope the risks are clear to you. I hope risks are clear to you. Okay. Okay, some people are saying that voice is low. Can you please tell me, is everything is fine with the audio or not? Okay, we can start. I'll try speak louder for this session. Okay. The Indian economy and the financial system are strong. That means the Indian economy's financial system is strong enough. Why? Because the balance sheets of the banks and the non-banks are showing healthy balance sheets. That means they have created enough provisions with them, and they are earning good amount of profits with them, and hence we can say that the Indian economy is financially stable, and this is also supported by the solid macroeconomics condition that also include investments by the companies and the individuals, and this also include consumption that has been made, the increase in the consumption by the urban and the rural people. Okay, now these are the part that explains that why the Indian economy is financially stable. Okay, banks are in good shape. Okay, why? Because they have enough capital with them. They are maintaining the liquidity at par, which is good for the bank, and profitability, that is the rate on assets and rate of on equity, is 10-year high, which is a good point, very positive point for the financial stability of the financial sector. And bad loans like GNPA and NNPA is all time low, which is also a good point. We are not discussing the facts here, because we are going to discuss it later in our later slides, and hence we are covering it in an overview, as an overview of the report. Now, the stress test shows that the most banks have enough capital to handle tough situation. That means they have created enough provisions, they have enough capital buffers with them in order to ensure that they survive in, even if in the times of crisis. Okay, so mutual funds and clearing corporation are also resilient under the stress. So they have RBI has conducted a stress test. Now, what is this stress test, they make sure that at the time of crisis they take hypothetical numbers with them, and they check whether these banks are going to be resilient or will be able to survive in this time of crisis. These are going to be a stress test. Okay, this is how they conduct the stress test with them. Okay, NBFCs are performing well. So NBFCs are performing well and have their strong capital, good earnings, and better asset quality with them. Okay, the insurance sector's solvency ratio is above the required minimum, ensuring its financial health. Now, what is solvency ratio? Solvency ratio is a kind of net worth. Okay. Now, how do we calculate it? Available solvency margin divided by the required solvency margin. What do I mean with this? Consider it as net worth of the insurance sector. Net worth of the insurance sector. Okay. Now, if the net worth of the insurance sector is more than the regulatory requirement of net worth, then we will call insurance sector as resilient and financially stable. Okay. Now, why we are looking at the net worth? The net worth shows that the insurance company is able to fulfill their financial obligation, and this metric shows that whether the net worth of the insurance company is well enough in order to pay off their financial obligations. And this metric, if it is more than 150%, is considered to be good one. Okay, anything greater than this will be considered to be good indicator for the insurance sector. And considering this, the report says that the insurance sector is also resilient. Now we will move towards the main chapter of this report. Now we will first discuss about the global projection, then we will move towards the India's projection, and slowly we will move towards the banking, NBFC, microfinance institutions, mutual funds, and such, and so on and so forth. Okay. Okay, so global growth projections. Now, what are the projections that are being made by the international institutions like IMF and World Bank regarding the global growth? Okay, so IMF says that the global growth is expected to be 3.2%, very important data for 2024-2025. Okay, and World Bank says the projection is going to be 2.6% and 2.7% in 2024 and 2025. Very important data. This can be asked in your phase 1. So do remember this. Now what happens that अभी currently क्या आई है? FSR आई है, right? December में आई है. Now one more will be issued in somewhat June or July. Okay. So many of the students ask कि मैम कौन सी वाली पढ़ें? The latest one or the oldest one? Now both the reports are really very important. Why? Because the newest one is the latest one, so you have to remember all the data related to this, because this can be directly asked in an examination. Now what about this, the older one? Now आपको इसमें क्या करना है, that इसके भी data आपको याद रखने हैं, so that you can compare the data between the two. Okay, and you can also use this data in your descriptive answers as well. So hence both the report carries equal importance, and hence we are discussing it here. Okay, so I hope global growth projection में कोई doubt नहीं होगा. It is not very technical, it is very simple. Okay, now we will talk about the global public debt. Now they are saying that global public debt has exceeded the $100 trillion, which is 93% of the global GDP. Now tell me, if the GDP, that is the production or the, we can say, earnings of the global is less than the debt, then it is a problematic situation. A debt should be less. Okay, but here we can say that it is 93% of the global GDP, and it is showing a significant problem in the metrics. And hence, what are the reasons behind it? That US and China are the most prominent or dominant economies that are leading towards this problematic situation, which is 93% of global GDP's debt. Okay, अगर हम देखें यूएस का डेट कितना है, $35 ट्रिलियन है, और चाइना का कितना है, 16.64. तो दोनों को मिला के above more than 50% of the debt is being related to US and China, and this is a problematic situation. Why? Because in case to US or China have some problems, some financial stability related problem, then a crisis due to these two countries can lead to a crisis at global level, and hence this is a problematic situation. A global debt of 100 trillion is not a good sign for a financial stability economy. Okay, now this is expected to be surpass 100% of the GDP by 2030. Again, a very important data. Okay, so these are the charts that are showing you the projections of the global level. Okay, now the blue line says about the emerging or the developing countries. Now developing countries का World Bank के according क्या है projection? That there is a 4%, there would be a 4% growth in 2025. Okay, and advanced economy or developed economies का कितना रहेगा, 1.7%, and overall कितना रहेगा, 2.7% in 2025 by World Bank. Okay, अगर हम IMF का देखें, the developing countries have a 4.2% of the GDP projections. Advanced economies की 1.8% है, and overall 3.2%. I hope this is clear. The data is clear to you, and you have to remember this data. Okay, now we have come to the projections related to India's level or domestic level पर हम अब बात करेंगे. Okay, the real GDP has slowed to 6% in first half of the 2024-2025. तो अभी रिसेंटली अगर हम न्यूज की बात करें, रिसेंटली कितना चल रहा था डेटा, somewhat 8.8% or somewhat related to 8. Now the projections has made it to 6%, which is a significant decrease in the GDP expectations of growth. Okay, so it is comparing to the 8.2% in first half of the 23-24. So we can see that there is a significant decrease, showing that the upcoming projections, the upcoming GDP growth is going to slow down. Okay, if we talk about the finance ministry has also recorded the GDP estimations of 6.5% in financial year 2024-2025. Very important. So all such institutions are aligning the GDP's growth estimation at a single line, because they all are expecting it to be slowed down in a coming financial year. Okay, and what are the reasons that why this much growth will happen in the GDP estimations? Okay, now the reasons are that there will be more rural and urban consumption, and there would be a pickup by the government consumption. That means more investment will be made by the government sector, and investment and strong service exports. So the service sector is improving immensely towards the export. Okay, so exports are good for the economy. If services are getting exported by our Indian economy, that will help us reduce our current account deficit. Okay, so this is going to be a good sign for the economy, and hence that growth of 6.6% is being recorded at yearly basis by the report. Okay, and these are the reasons. Okay, now what are the risks that can hamper this growth estimations? Okay, so what if there is a decline in the industrial activity? Suppose people are not investing much, or they are not borrowing from the banks, and they are not investing in the market. If there will be less investment, the employment level will fall down, and Consequently, the consumption level by the urban and the rural people will also fall down, which is not a good sign. So decline in the industrial activity can lead to a risk to the GDP growth. Second says moderation in the urban demand. What if people are not demanding goods and services? The people who are living at the urban areas. So a slowdown in the urban demand can also be a risk for the GDP estimation. The third point says global economic spillovers. What if due to global economic spillovers there is a problem in the financial stability report? What do I mean with this? Suppose there is geopolitical tension around the corners, right? Countries are entering into wars, and there are many problems related to such border lines and all such things. And suppose the citizens of the countries are not feeling secure, they are not really very confident enough regarding the upcoming scenarios, and the situation around the people are very uncertain. In that case, people will try to hold their money instead of investing or spending it, and which is again not a good sign. And hence, a global economic spillover is not a good sign for the economy. Okay. The fourth point says protective trade and industrial policies. What if some countries introduces some policies that are not good for the other countries? Suppose एक एग्जांपल लेते हैं, अभी रिसेंटली यूएस यानी कि द प्रेसिडेंट ऑफ द यूएस ट्रंप ने ऐसी पॉलिसीज, टैरिफ पॉलिसीज प्रपोज करी हैं जिसमें दे आर पुटिंग हाई ड्यूटीज ऑन इंपोर्ट. ओके, इन केस the US citizens are importing from a particular country, the import tariffs or the import duties will be very high. So they are protecting the US citizens to not to buy goods from the another country, and also they are protecting their deficits to be increased. So their agenda is to reduce the deficits. But this is not good for other countries. Why? Because exports कम हो जाएंगे बाकी सब countries के, and hence this is a problematic situation for other countries. Now policies like such can also be a reason why there is a less GDP growth or less GDP projections by the economists. Okay, I hope this is clear. This is very simple. अभी के लिए कोई टेक्निकलिटी नहीं है. Okay, so now we are going to discuss about the external sectors. Now we will going to discuss about the FDI, FPIs, exports and imports, how they are going to work in the upcoming scenario. So the merchandise trade, okay, the exports are expected to grow 2.2%, whereas imports are expected to rise 8.3%. Okay, these are the actual data. These are not projections, these are the actual data. Now you can see that there is a gap. There is a gap, 2.2% and 8.3%. Now the gap is huge, and this has led to deficit. Okay, if we are importing more, we are buying more than selling, then it will lead to a loss. This is the loss for the country. We call it as current account deficit, and because of this huge gap between the export and import, there is an increase. There is an increase in the CAD, that is 1.2% of the GDP in the first half of 2024-2025. And what we are importing, imports are driven by which sectors? First is the gold one, petroleum sector, crude and other products, crude products, and electronic goods. And these are the reasons why we are expecting, or we are facing significant increase in the imports. Okay, so these are the reasons. And now there is a increase in the deficit due to this difference in the percentages, or we can say export and imports. Okay, now the financial accounts is a part of BOP, that is balance of payments. Balance of payments एक account है जिससे हम क्या देखते हैं, that how much we have made payments and received payments, actual flow हमें पता लगता है कैश का. So financial account क्या देखता है? FDI, FPI, all such things. तो कितने FDI आए हैं, कितने FPI आए हैं, all such things are important for the economy, because FDI से क्या होता है? FDI is for a longer period of time, the investment that are made by the individuals or companies in India for a longer period of time, that will subsequently increase the employment rate, right? Investment will increase, the employment will increase, the consumption level will increase, and hence the GDP of the economy will increase. These are very important. And what report says? Report says that there is a moderation in the net FDI. So people are not investing much in the FDI. Okay, there has been a slowdown in the FDI. Okay, foreign direct investment, and there has been a increase in the FPI. Now, what are FPIs? We have already discussed in our previous sessions as well, that FPIs are for the liquidation of the financial market. They ensure that our rupee do not fall or depreciate significantly. So a good number of or good inflow of FPI ensure that rupee is stabilized, the financial market is enough liquidate. Okay, so what they do, they purchase shares, bonds, debentures, okay, securities like such in the Indian market in order to earn, with an objective to earn quick profits or short term investment. Okay, so these FPI have recorded 12.7 billion inflow, okay, supported by the strong debt flows. Now FPIs are more interested in the debt securities, that are bonds, okay, government securities that are giving them fixed returns. So FPIs are interested in debt flows. So major driver behind such growth or such inflow is debt inflows, okay, debt flows, okay, higher ECB's borrowings and increased non-resident deposits. Now, what are the other parts of the financial accounts? There are two things, that is external commercial borrowings and the non-resident remittances. Now, non-resident remittances are the money that are being sent by the non-resident, the people who are living in the foreign countries are sending money to their people in India. Okay, now these are the remittances, and these are also important for the economy. Apart from this, external commercial borrowing, that means the institution or the government of India who has taken loan from the foreign or the international institutions. Now, how much loan has been taken by our government and our companies are a part of external commercial borrowing. If we are borrowing too much, if we are borrowing significantly high, then this is also not a good point. And as per the FSR report, it says that there has been a higher ECBs, that is higher external commercial borrowings by the institution and by the government of India. Okay, and deposits made by the non-resident, has also increased. So you can see there is a mix of indicators that we cannot easily conclude whether it is a good point or not, but we are covering this as a financial account, that these all are the factors that we are considering as a financial stability, to check the financial stability of the economy. Okay, so I hope it is clear. Now we will talk about the foreign exchange reserve, that the total reserve as of December 2024 is 644.4 billion, which is the fourth largest foreign reserve made by India. Okay, we know that now the foreign exchange reserve has reduced a bit because of rupee depreciation, but when we will come with the new FSR report, the new data will come. This is the foreign exchange reserve till December 2024. Okay, let's talk about the fifth data, which says indicators of external sector sustainability. The forex reserve covered 99% of the external debt. Whatever debt we have, the foreign exchange reserve covers 99% of this. Now this is a very positive sign, because we are able to fulfill our financial obligation through our reserve. Okay, so this is a good point. And the next point says that with 2/3 of the ECBs hedged, that means the commercial borrowing, the external commercial borrowings can be paid off or can be hedged, can be reduced through hedging in the securities. Okay, now the obligation under the ECBs are being reduced, can be reduced by hedging in the securities, and this amounts to 2/3 of of the ECPs. Okay, I hope everything is clear till now. I will take your doubts at the end of the session. Okay, so now we have come to the banking system. Okay, first we discussed global level, we come to Indian level. Okay, we talked about external sectors. Now we have come to banking system. Now we will discuss some key metrics and indicators regarding the banking system. These indicators are very important. Understanding what are these indicators and what is their factual point, both are very important. In the examination you can also ask about what these indicators mean and what's the formula of them. Okay, so you will find formulas and all other such things in the PDF itself that we are going to provide you in the RBI 247 magazine, but we are going to discuss each and every metric, their meaning in a very briefly manner. Okay, so first let's just discuss about the banking sector and their soundness indicators. Okay, so the first point says gross advances in rupees lakh crore. So if we talk about the latest data, which is September 2024, it is 167.8 lakh crore. So all the loans and advances given by banks to the individuals, to the companies, all such, if we accumulate all such loans and advances by banks, it is accounted to be 167.8 lakh crore. Very important data. Okay, now the second point says about the gross NPA. Gross NPA, we know what is NPA. NPA is a bad loan. Now when we on a gross level, in a total level, how much percentage is this? This is 2.6%. Okay, 2.6%. If we can compare it with the March data, March 2024, it was 2.8% in March 2024, and now it has been decreased to 2.6%. So we can say that the number of bad loans have reduced, and it is a good point for the banking sector. Okay, the third point says that net NPA. Now what is the difference between a gross NPA and net NPA? When we reduce all the provision, when we deduct all the provision from the gross NPA, we reach to NPA which are not protected by the provisions. Okay, so what is the percentage of this net NPA? It is 0.6%. Before this it was also 0.6%. 0.6%. It is 0.6% as on September 2024 as well. Okay, fourth point talks about the rate on return on assets. Now whatever assets banks have, what is the return on those assets? What are the profitability? This is a profitability ratio. Remember this thing, this is a profitability ratio. And what is the percentage that banking sector has recorded as per this FSR report is 1.4%, which is increased from 1.3% in March 2024. So in March 2024 it was 1.3%, and now as per the FSR report it has recorded 1.4%, which is a good sign. Again, a good sign, a positive sign for the banking sector. More profitability, if there are more profitability for the banking sector, it is good for them, right? Now we will talk about CRAR. We also call it as capital adequacy ratio. Now what is capital adequacy ratio? Capital adequacy ratio in simple terms, if I have to explain it to you, it is a capital that must be there with the bank in order to fulfill all the financial obligations. Okay, enough capital, the metric to a metric to calculate whether the banks have enough capital with them or not. Okay, so this is being assessed or calculated by the CRAR. Okay, and what is the percentage of it? Is 6.7%. In March 2024 it was 16.8%, but now it is 16.7%. So we can see that there is a slight moderation in the CRAR. Okay, we can also understand this with the help of that why there is a moderation, because there was more regulatory requirements by the bank at the end of November, right? NBFCs were not allowed to give more unsecured loans. Banks were not giving loans to the NBFCs, and they are also keeping more provision or risk weights towards the personal loans, and hence we can see that CRAR is being there is a slight moderation in the CRAR. Okay. Now the 6 point says the LCR, that is the liquidity coverage ratio, that a bank should have enough liquidity in hand for the next 30 days. Okay, all the transaction that is to be made for next 30 days, all such the money in hand must be with the bank for next 30 days. Okay, so this is 128.5 percentage. Before it was 130.1 percentage. Okay, LCR, LCR, LCR which is more than 100% is indicated to be good. Okay, LCR which is more than 100% is indicated to be good, and we can consider 128.5% as a positive sign as well. Okay, let's talk about the PCR. Okay, this is a provision coverage ratio that talks about whether the banks have kept enough provisions of NPAs with them or not. Okay, now the PCR is 77%. Is 77%, which is again a good point, because PCR between 70 to 80% is considered to be good and considered to be efficient enough for the banks and the financial institutions. Okay, now we come to the last indicator, which is slippage annualized percentage. Okay, slippage. Now what is slippage percentage? This talks about how much performing assets is being converted into a non-performing assets. Okay, how much good loans has become a bad loan. Okay, so we call it as slippage percentage. Okay, so the less it is, the more good it is. Okay, so it is 1.4%. 1.4% in September 2024. It was 1.6% in March 2024. So we can see that there is a quite decrease, a slow decrease in the slippage percentage, which is again a good point. So from this chart we can say the overall banking system is stabilized enough and is financially stable and resilient enough to deal with the crisis. Okay, now we will discuss these points. Okay, here also some of the points are duplicate in nature. We will try avoiding that, and some of the points are new, so we'll discuss it on it. Okay, the first point says the capital strength. We are discussing about the banking system again. The capital strength, that is the common equity tier. Now the tier 1 capital, is about equity, contains equity and reserves. Okay, and this should be enough with the banks. It is 14%. However, as per the regulatory requirements, it is 8%. So they are keeping the tier 1 capital well above the regulatory requirement, which is again a good point. If we talk about the profitability, we have already discussed about the return on assets, which is 1.4%. But in terms of return on equity, that is profits divided by the shareholders' equity. Okay, we call it as return on equity. Profit in comparing with the shareholders' equity, it is 14.1%, which is again a good return on equity. Okay, now we will talk about the asset quality. We have already discussed that GNPA is 2.6%, which is multi-year low, and the NNPA is 0.6% due to strong provisioning, because the provisioning of the banks have increased, and hence the NNPA is all-time low. Okay, a special mention account, SMA2, low risk of loan defaults. Now what is SMA? SMAs are special mention account. Okay, they are categorized into three categories. Okay, now there are SMAs 0, SMA 1, SMA 2. Okay, now banks do not directly transfer their bad loans or their non-performing loans as NPA. Okay, there is certain criteria. First, they keep it under SMA, which is 0 to 30 days. If the loan is not payable between these days, it is considered as SMA. SMA 0. Okay, if the loan is not being paid for these much days, it will be SMA 1. Okay, if the loan is not payable for these many days, then we will consider it as SMA 2. Okay, and if the loan is not repaid for next or over 90 days, it will be considered as NPA. Okay, I hope it is clear. It is a very simple concept. Okay, so SMA, that is the special mention account 2, there is a low risk of loan default. That means there are less risk that these many people will default on loan. So it is a good point that people are not defaulting on their loan, and hence this is also a good point. Now, key risk indicators, banks flagged as deficient under the key RIs framework. Okay, first we will understand about the key RIs framework. Now, what is KRI framework? Now, the performance of the bank is based on few indicators. We will consider it as CRAR, okay, liquidity, right? We judge the performance of the bank based on these indicators: profitability, okay, return on assets, return on equity. Now these are multiple indicators, right? Multiple indicators based on which the bank's performance is being judged. What if there are certain banks who are not performing well in terms of these key metrics? That means their performance is deficient in nature in these multiple, in more than one or more than two indicators. So we will consider them as KRI, key risk indicators. We will put them under key risk indicators framework. Okay, and as per the report of the FSR, it says it has been reduced from 75% of the banks to only 3 banks. Okay, so earlier there was 3/4 of the banks were under the KRI framework, which was not good, and now it has been reduced to only 3 banks. Okay, only 3 banks are there who are under the KRI framework. Okay, and their assets account for 15% of the assets, of the total assets. Okay, so they amount 15% of their total assets. Okay, this shows that there has been still a significant amount of assets that are being recorded by them. All right, so the risk is still with them. Okay, even if the number of KRIs has reduced, but their significance is more. Okay, so this is what this indicator says. Again, we are discussing the banking system. Let's discuss about the deposit profile of the banking system. Okay, so the deposit profile says the decline in the CASA deposits. Now, CASA is current account and saving account deposits. Okay, now why these deposits are important for banks? Because they are cheaper cost. They are available for banks at cheaper cost. They have to give less percentages. They have to pay less interest rate on them, and hence their decline is not good for the economy, good for the banking sector. However, the term deposit, that is fixed deposit, has been increased. There we have seen there is a rise in the term deposits. Okay, so which is again a good point. Okay. Okay, so there is a 82% of the incremental, there is a 82% of the incremental deposits were in term deposits in first half of 2024. So 82% of the term deposits were recorded in the first half of the financial year 2024. Okay, the cost of fund, that is the cost of fund, has increased by 148 bps. That means there is a slight increase in the cost of fund for the banks. Again, it is not a good point, but this is a slight increase since March 2024, March 2022. So we can consider it as mild risk. Okay, so retail loans. Okay, the regulatory measures led to a slowdown in September 2023. So September 2023 में RBI came up with the regulatory requirement wherein they have to the banks and the NBFCs have to create extra provision for the unsecured loans and the personal loans, and hence this regulatory requirement has lead to more there is a reduction in the growth of retail loans, and the growth has reduced to 13% from 26.9% in September 2023, and banks lending to the NBFC has also decreased from 28.7% to 6.4%. Okay, so we can see here from the data as well. Okay, the GNPA for the retail loans, now GNPA, that means specifically in the retail loans, the loans that are given to the individuals, for personal loans, for car loans, all such, the NPA in that particular sector is 1.2% as of September 2024, and the GNPA for the unsecured one, okay, is 1.7%. Okay, the investment by the banks, okay, 66.9% under the HTM, that is held to maturity category, and not a significant amount of investment is made to mark to market. Now HTM क्या होता है? HTM is when a bank holds a hold the securities till it maturity. Okay, till it maturity. तो अगर मेच्योरिटी तक उसे होल्ड कर रहे हैं तो उसमें जो लॉसेस हैं और उसमें जो वोलेटिलिटी है इन द मार्केट ऑफ देयर प्राइसेस इज लेस, and hence it is a safer option for the banks. But if we talk about mark to market investment, they have to create provision for the same, because the prices of such securities keep on fluctuating, and hence bank has to maintain a provision for them, and they have keep on revising their balance sheet as per the revised value of these securities. And hence we can see from the data that more than 50% of the investment by banks are under the HTM category and not in the M2M category. Okay, now the liquidity coverage ratio has declined from 135.7% to 128.5% in September. We have already discussed this point in the chart as well. Now, if we talk about the public sector banks, it has shown a sharp decline in the liquidity coverage ratio. If we are talking about the public sector banks, okay, the government banks, their LCR, that is their liquidity coverage ratio, has been declined to 127.4% from 142%, which is a significant fall in the liquidity coverage ratio. If we talk about the NBFC sector, the financial performance is being good. How? Because they have maintained a CRAR, a capital buffer with them of 26.1% as of September 2024. If we talk about the profitability, their net interest margin is 5.1%. What is net interest margin? It is the gap. It is the gap between what bank pays and what bank get. Okay, whatever interest they lend from the borrowers and how much they pay to the depositors, the gap between the two is the NIM. The more it is, the more good it is. Okay, so 5.1% has been recorded by the FSR of NBFC sector as NIM. Okay, the return on asset is 2.9% by the NBFCs. Asset quality is 3.4%. GNPA की अगर हम बात करें, if we talk about the special mention account that we have just discussed in our previous slide, दोनों तरह के यानी कि 1 और 2 SMA कैटेगरी को अगर मिला दिया जाए, then the asset quality is 3.5%. Okay, the write-off. Okay, write-offs क्या होते हैं? Whenever a bank consider or categorize a certain loan as bad loan, they write off that loan in the subsequent years. Okay, so however the borrower is still obliged to pay such amount. However, but banks do, they remove such bad loans from their balance sheet and create a provision for them. Okay, so the more write-offs are being done by the banks are not good for the banks. Okay, but they do such things in order to maintain the account framework. Okay, in order to maintain the accounts framework. Okay, So there has been a rising trend, okay, with certain outliers in NBFCs showing significantly higher write-off. That means there are few NBFCs that have a significant high write-off with them, okay, which is again not a good point for the NBFC sector. Now we are discussing about the lending trends and the borrowing trends. The amount that the NBFC borrows from the banks and other financial institutions, and what they lend to other borrowers. So first we are talking about the lending trends. So overall growth, that the NBFC loan growth has moderated to 6.5%. That means there has been a reduction, or we can say a slowdown in the loan growth. Okay, there is a slowdown in the loan growth that has been reached to 6.5% by September 2024. Why? Because there was a increase in the risk weights by the RBI. Okay, as we already discussed that the risk weights of the unsecured loans were increased by 25 bps. Okay, if the provision was earlier 100%, it was asked to be maintained at 125%. If the provision was at 125%, it was asked to be level it as 150%. Okay, so there has been a 25 bps increase in the provisioning, or we can say risk weight, which has reduced the loan growth in the NBFC sectors. Okay, if we talk about the upper layer NBFCs, they are dominated by the NBFC ICCs. Okay, and they are giving what? They are giving more of retail lending loans. That means loans given to consumers, individuals, for the car loans and the personal loans, which is again not a good sign for the NBFCs. Why? Because personal loans are not all personal loans are not collateralized. Okay, and hence it is very important for them to be secured by the provisions, or upper layer NBFC can avoid giving such loans in the market because they are not secured. Okay, so this is a sign of stress or a sign of risk here. Okay, now the liabilities and the borrowing trends. If we talk about the bank borrowing, that means the NBFC that have taken loan from the banks, we can see that there is a decline from the bank borrowing, that is 26% to 17%, because banks are not giving loans to the NBFC, because banks have to maintain extra provision for the loans that are being given to the NBFCs, and hence the loan by banks to the NBFC has reduced, and we can see this from the data given here. Non-bank sources, that means the funds that are being raised by the NBFCs through the financial market, through commercial papers or certificate of deposits, we can see that there is an increased reliance on such, which is increasing the cost of funds. Now banks and NBFCs are increasingly demanding the certificate of deposits and the commercial borrowings to attract the funds in such sources, alternative sources of fund. They also have to provide extra rates, and we can see this, that there has been an increased cost of funds by the NBFCs. Okay, if we talk about the foreign currency borrowings, that means the borrowings that are being taken by the NBFC from the international market, we can say that there is a reduce in the overall cost, and it is being used by the NBFC to diversify their funding, and this also poses a currency risk if the borrowing remains unhedged. In case the banks, NBFCs are not able to hedge thus risk, the currency risk in that international borrowing, this could be a risk, because the currency, because the borrowing that are being taken are in the dollar terms, and the value of dollar keep on increasing and increasing. If this fluctuation is not hedged by the banks, NBFCs here in a effective way, this could lead to a problematic situation for the NBFCs. Now we are discussing some risk factors related to NBFC. What are the risks in the NBFC sector? It is the economic slowdown. What if there is a economic slowdown? The growth and the production and the investment and the consumption by the each and every company and the individual slows down. It can impact the NBFC sector as a whole. And some regulatory changes, as we can have seen in the past, that us regulatory changes has put a significant impact on the NBFCs and their loan growth as well, and we can consider it as a risk to the NBFC's growth. Okay, failure of a large NBFC. In past, there has been a recent, we can say, there were many examples wherein NBFC has surrendered their license because they were not able to survive in such competitive world, and hence they have lead to a failure. Okay, and this is again a very risky thing for an NBFC. Okay, situations like COVID-19 pandemic, such situation can also hamper the performance of the banking sector. Tight monetary policies, again policies like that are tightening the liquidity measures, that or not much borrowing must be done in the market, or there should be a less liquidity with the in the hands of the people. Regulatory policies like such can again hamper the NBFCs because their main agenda is to lend, okay, to make the people of India more financialized. Okay, so we will discuss here the microfinance overview, the overview of the financial microfinance institution. We will discuss about this as well. Okay, so between the June 2021 to March 2024, the credit by the microfinance institution has increased, has grew at a rate of 24.4% per year. So at a per year, we can say it from 2021 to 2024, it has increased at a growth rate of 24.4%, which is a good point. And the number of borrowers have also growth from to 11.11%. Okay, 11% they increase हुए हैं. Okay, the second point says, however, some lenders like NBFC, MFIs and other non-MFIs NBFC saw even higher growth, 33.5% and 33.4%. So these two NBFC type of NBFC have seen a significant growth in the credit sector. Okay, from March 2024 to September 2024, the number of loans has delayed in this much time, that is 31 to 180 days. Okay, and this has been increased from 2.15% to 4.3%, which is again not a good point. The more delinquencies are there in the loans, it is not profitable for the banks because there is high chances of default by that borrower. Okay, the fourth point says the number of borrowers taking loans from 4 or more lenders has increased. That means a single borrower is taking loan from one or more borrowers. So one or more lenders, which is a risky point. What if that single borrower defaults? So it will be a default for not one bank, it will be a default for 4 banks, which is again a risky point for the micro financial institutions. The fifth point says the average loan amount has gone up to 43%. That means the amount of loan that has been borrowed by the borrowers has been increased by 43%. Earlier it was 35,000 something. Now it has reached 50,000 something in financial year 2024-2025. Okay. Okay, we have discussed this. Let's move to next, which is the consumer credit. Okay, now we are discussing about the consumer credit sector. Okay, so we can see that the loans in the personal consumption has grew. We have also discussed the same in the NBFC's sector factual data as well. Okay, and from March 2021 to December 2023, the consumer credit has grew by 20.6% annually compared to 14.8% in loans. So in the personal loans, in the consumer credit loans, we can see there has been a significant increase. However, this slowed after regulatory restrictions in late 2023, that is September. Okay, we can see that there is a reduction in the consumer credit and the personal loans. Okay, if we talk about the mutual fund, the asset under management, that means the asset that are being held by the mutual fund companies are currently at 68.1 lakh crore. Very important data, and it is being grew by 38.8% year on year basis. Okay, if we compare it with the November 2024 and November 2023. Okay, and what are the reasons? Because people are more investing in the equity schemes, because equity gives more return as compared to the non-equity schemes like debt schemes, and hence this is a major driver behind such increase. Okay, and what else? SIPs. Okay, we all know that SIP, people are investing more and more in the mutual fund and the SIPs, and hence it is also one of the key driver why there has been an increase in the asset under management by the mutual funds. Okay, in the year 2024 up to November 2024 का data हम discuss कर रहे हैं यहाँ पर. The debt schemes attracted 3.46 lakh crores. So we can see there has been a significant increase in the investment by the investors in the debt schemes under the mutual fund sector. Now this is a discussion that was made in the financial stability report, wherein they discuss about the artificial intelligence and its potential risk in the financial sector. Okay, so here we are discussing it. Why we are discussing it? You can use this information in your descriptive answers as well. Okay, this is going to be very important for you. So hence we are discussing it here very shortly. And we all know what is artificial intelligence. We use it daily on a daily basis, and we can see that there is an over reliance of us on artificial intelligence. Now the major risk that has been talked by the FSR is, what if this artificial intelligence or the system or the service providers that are providing us this technology collapse? Okay, what if this system collapse? So our whole system might collapse because we are more relying on it, and hence there is a need to regulate it. Okay, give more powers to the regulators, give them more tools to the regulator to regulate them. Okay, now we will discuss it one by one. Okay, so majorly what are the benefits? That it is a large unstructured data. It assesses or processes large unstructured data very quickly. It is very efficient. In a very less time or no time, it gives you the analysis of the data, and there is a improvement in the scalability and the adaptability of the AI, because it is generative AI. That means it keep on learning or adding more data into its system, which makes its prompts, which makes it responses even more accurate and reliable. Okay, it is used in various sectors, like we can use it in cyber security sector, right? We can use it in financial service sector. We can also use it in customer support, right? We have seen that the AI has been used by many of the sectors. We can also use it in education sector, right? So all these are the main sectors where the AI is being used. Now what are the challenges? First is the model risk, that some things in the AI technology we cannot explain it, or it is not explainable to the users because of this black box problem, because everything is happening behind that coding, behind that computer, right? Now each and everything on the errors that are being given by that AI is not explainable, and hence it is lack of explainability, right? Now there are potentials of bias and faulty prediction. What if we gave them wrong data and they are giving us wrong prediction, right? So this is a one error that we can say. A poor data lead to a poor quality of assessment and analysis, which is a kind of model risk here in artificial intelligence. Second is interconnectedness. I have already told you that if each and every financial institution, if each and every bank, even insurance companies are relying on this third party service, which is artificial intelligence, then a collapse of this artificial intelligence can lead to a collapse of these financial institutions, which shows that there is an interconnectedness in the systems, and hence there is a risk of interconnectedness. That over reliance on this technology can lead to a data threat also, right? So this is what we have discussed here, that market concentration in AI service and cloud service providers. What if they collapse? Okay, now this point says the cyber security risk. Again, what about the data? What about the pictures that we have in our device? What about all the personal information? What if they got hacked by this system? Okay, so there is a cyber security risk to that. Okay, so we have also seen that there is a deep fake attacks. That means the picture that are being used by the AI to create a video and audio like such such things are the examples that how a cyber security risk has increased with the evolution of AI. Okay, use of generative AI for cyber attacks, again same thing. Market risk, the speed and the volatility in the capital markets. Now with the ease of using this AI and the technologies, now we are available with the information at a much speeder way, right? Now with increase in such speed, we are increasing the speed of our decision making as well. And people, we can see the same in the capital market, in the financial market as well. With a single information, within 2 to 3 hours, we can see the impact of such information in the securities, right? Suppose there is a company A, उसके shares बहुत अच्छे चल रहे थे, everything was fine, and one bad news collapse the rate of that securities, right? And all other investors lead to a losses. Okay, so we can see this in the market risk, right? With the more availability of that immediate data, the capital market has become more volatile. Highly correlated AI trading strategies may amplify the stress. Now people are using AI to trade in the market. Now if AI is giving you the trade strategies, the same trade strategies is being given to any other person, which is again a very complicated and is a very risky point here. Okay, the third point says the migration of activities to NBFIs, increasing opacity. Now what these points are discussing, that NBFCs are also using these AI. Okay, and what if borrowers are moving away from the traditional banking to the NBFC? Okay, now this will also lead to a risk. Okay, because NBFCs are not regulated by the RBI. Okay, they are not fully regulated by the RBI, and hence this also possesses some kind of risk. Okay, systemic risk, a non-linear transition of risk from individual firms to the financial system. Suppose there was a risk concentrated with that one particular single company, and now the risk has emerged into the financial sector as a whole, and this is a systemic risk due to high technology penetration and the vendor concentration, because AI is being used by each and every participant in the market, and hence due to interconnectedness, there is a risk of systemic risk. Okay, which is unavoidable. Now what are the recommendations that are being made by the FSR report with regard to AI? That there should be a balanced report. We should acknowledge the benefits of the AI, but the risk cannot be avoided here. The risk that are being attached to the artificial intelligence cannot be avoided here. Okay, the second point says the skills and tools updated. That means regulators should be equipped with sufficient tools and skills in order to regulate such AI, in order to mitigate the risk of the AI. Okay, third is proactive frameworks. That means instead of using AI for our day-to-day life, we should use AI in order to detect or identify whether what are the potential risks of AI in the market. Okay, so the use of the AI can be diversified here. Okay, so I hope the recommendations are clear here. Now we will come to the question session. We will complete this very quickly. Okay, match the following terms with their correct description as highlighted in the financial stability report. Now what is LCR, what is M2M, what is HTM, and what is asset under management? Match the each with their respective definition and description. Okay, is there no voice? Is everything is fine with the audio? Please tell me. Few people have said that there is no voice. Is everything is fine with the video? Please tell me, is everything is fine with the audio and the video of the session? Okay, fine. Thank you, Afsana. Thank you for telling me. Okay, tell me what is the right answer, what is the right match? Okay. Okay, So LCR is measures bank's ability to meet the 30-day liquidity. Okay. Mark to market is investment held until maturity without, sorry, this is for the third one. Okay. The mark to market is adjusting the investment to market prices, and asset under management is the value of the asset managed by the financial institutions. Okay. So what is the right point here is basically C is the right option here. Okay. The financial stability report December 2024 highlights the Indian economy GDP growth projections for financial year 2024 and what is the projected growth rate mentioned in the report. Okay, what is the India's GDP report? India's GDP growth projected by the FSR 7.2%, 6.5, 5.8, 6%, 8.1%. What is the correct answer? अभी वो ईयरली पूछ रहे हैं, हाफ ईयरली पूछ रहे हैं. ओके, सो टेल मी व्हाट इज द करेक्ट आंसर. ओके, राइट, गुड. B is the correct answer. 6.5 is the right answer. Okay, good Afsana, good Ayush. Okay, let's come to the third question. Match the following key terms with their explanation as per the financial stability. Again, यहाँ पर आपका static part check किया जा रहा है that whether you are well aware with the these terminologies or not. Okay, so capital to risk weighted asset ratio, return on assets, financial system stress indicators and net interest margin. Okay. ठीक है, हमने इस बारी इसके बारे में नहीं पढ़ा. वी विल डिस्कस दिस इन द सेकंड चैप्टर ऑफ द एफएसआर, बट आप एलिमिनेशन मेथड से भी इसको सॉल्व कर सकते हैं. लेट्स सी, कैन यू सॉल्व इट और नॉट. राइट, राइट करण, राइट एके. सी ऑप्शन इज द करेक्ट ऑप्शन. ओके, लेट्स मूव टू द फोर्थ question of the session. According to the financial stability report, which of the following statement is true about the mutual fund? Okay, so the mutual fund experienced a 38.8% growth in the asset under management. Second point says that debt schemes attracted 3.46 lakh crore in inflows in 2025 financial year. The third point says equity schemes are underperformed compared to the non-equity schemes in the terms of growth. Tell me what is the right option in the given below. So basically statement 1 and statement 2 is the right statements and statement 3 is not a right statement. Why? Because people are investing more in the equity schemes instead of non-equity schemes. So this is a wrong answer and option C is the right answer. Okay, let's discuss this. The financial stability report mentions that the Indian foreign exchange kitna hai as of December 2024. So what is the right answer? 744.5 billion, 602 billion, 672 billion, 644 billion, 699.2 billion. Yes, yes, the option D is the correct one. 644 billion as of December 2024. This is the last question of the session. Everybody do participate. The financial stability report mentions about the GDP projection. Which of the following global growth projection is correct for the year 2024-25? Okay, now as per the IMF, here in option 1 it is 2.6% in 25. World Bank 3.2% in financial year 25. IMF 3.2% in financial year 25. World Bank 2.7% in financial year 25. World Bank 4% in financial year 25. What is the correct statement as per the FSR report? No, Abhishek, it is not C. Oh, right, it is C. Okay, right, Abhishek, you are right. Okay, right, Karan, right. C is the right option. Okay, so here we are done with our today's session. I hope you have liked it. I know it is quite lengthy today, but FSR is very important for all of you. So investing this much time is good enough. Okay. I will try cover all the news in the upcoming sessions as well. We know कि financial stability report December में आई थी, but I still covered it, but because of its importance. And if you want, I can cover the news. पुरानी न्यूज़ भी मैं काफ़ी ले चुकी हूँ अपने सेशंस में, कवर कर ली थी मैंने. So that much news is enough for the current affairs part. Okay. Okay, Shubham. So I think everything is fine with the today's session. Okay. Thank you for the session. I hope this session was fruitful for you. Okay. Best of luck and do prepare for the keep preparing for the current affairs because their weightage has been increased in the past. Okay. So best of luck, everyone. Best of luck.